Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us on this post-Labor Day, post-Schwab merger Market Carver. So we're filming this on Tuesday here, really the first day of having the accounts move over to Charles Schwab, and everything on our end looks very good. So that's always a comforting thing. We've done tons of prep, and all the congratulations in the world to Zaria Hodson on our team. Zaria Hodson Abbott, that is. I've known her for way too long as Zaria Hodson. Zaria has done a phenomenal job of preparing the team and making sure that all the accounts were ready to go. And so, fortunately, we're reaping the benefits of all that hard work and are beginning there. We understand that there'll be some online challenges and some new logins and all of that, and we just another reminder that we're out here to help you through those. So by all means, if you notice anything, any troubles logging into the new Charles Schwab website, please give us a call. We'd be happy to walk you through that. The content that we're going to walk you through today, we're going to talk about artificial intelligence, arguably the buzzword for 2023, but we're going to talk about it in a different light. And then Andrew's going to cover the technical side and give you a view here as we flip to the back part of the year on how things look technically. So let's start off with artificial intelligence. So again, that's been a big buzzword for 2023. We've talked about it many times here, and rightfully so, because any of the stocks, the main stocks that are contributing or behind the movement, have just soared in value. But the angle we want to talk about it from this week is a more concerning, and we'll call it on the personal finance side, and that is the rising fraud, and such that it's really, this stat just shocked me, and that globally scams, I won't read you the whole paragraph here, but have now reached $8 trillion, the size of the Japanese economy. So a truly staggering approach. And it was really, I think last year, maybe the year before, really began to understand the sheer scope and the scare that's behind a lot of these technologies. And in fact, you've probably seen reports, and if you haven't, just be aware that the technology is so sophisticated, it can grab name, image, and likeness, and video and audio, and present phone calls to you as if they were from a child or a grandchild. They're able to sound like them, answer questions like they would. And again, that can be provide an easy background for scam artists. So just as always, just a reminder here, a public service announcement, we'll call it, to stay on alert if you happen to get one of these. And maybe the more in-depth, or it's always a good recommended common practice to have some sort of a common term that you could all fall back on, or one thing that artificial intelligence wouldn't know or be able to answer about your child or grandchild. So that's what with AI. We actually got one more chart or stat to throw up there and kind of put this in context. All right, so here's a look at just the range of the scams that we've seen. It's not just nickel and dimes anymore, the small ticket items. It's actually gravitated into some big ticket, higher cost fraud claims. You can see they're over $10,000. There's been a stunning rise of those in 2022, over 86,000 of those. So with that, we'll pass the ball over to Andrew to give us a look at the technical side of the market.
All right, thank you, Adam. So we close out August, and last week we talked about the seasonality for September and how there could be a little bit of some bumps in the roads when we go into September. So we talked that was a little bit more negative. This week we have some positive news to share. When we start looking under the hood for how the individual sectors, individual stocks, individual industries, which we'll talk about today, they are still performing fairly well. So we just saw the market decline not even 5%. It then started to rally towards the end of August, and now we're actually less than 2% away from that prior 52-week high. Again, so when we look under the hood, see how all the individual components of the market are doing, we still have a fairly strong look of market breadth. The chart I'm going to share with you today is looking at the number of industries in the S&P 500 that are hitting either 52-week highs or 52-week lows. And we can see that on Friday, we had almost 12% of the industries hitting those 52-week highs. And during that decline that happened in August, if you look at the bottom panel there, you can see we had pretty much non-existent any 52-week lows from an industry perspective. What we typically see when the market begins to deteriorate is we start seeing an increase in activity of 52-week lows and less stocks and industries hitting 52-week highs. So what we want from a bullish point of view is we want to see a lot of industries, a lot of stocks hitting higher and higher levels. That shows good support for the uptrend of the broad market. And right now we are seeing quite a few uptrends still from an industry point of view. Now, the next chart we're going to look at is looking at it now from an industries. We're going to look at sectors. And so typically we want to see a lot of the offensive sectors. We typically group the market into an either offense or defense sector focus. And those are stocks or sectors like consumer discretionary, technology, industrials, energy, parts of the market that typically do really well when the market is rising. And then defensive sectors, consumer staples, utilities, healthcare, those a little bit less volatile components of the economy and of the market, those would be our defensive sectors. So when the market is rising, we typically want to see offensive sectors outperforming defensive sectors. You can see on this chart here, if we look back at 2022, that line was going lower because the offensive sectors, technology, consumer staple, or discretionary, communications, all of those types of stocks were underperforming those lower beta, those more safety defensive sectors like healthcare and consumer staples. Then, when the market began to improve in the back part of last year and throughout this year, we saw rotation once again go back towards offensive sectors. And even during that pullback we saw last month, again, where the market not even declined by 5%, we saw still a continued push towards offensive parts of the market to the point to where, as of Friday, we actually saw a breakout to a new high between offensive versus defensive sectors. And this is a positive for the stock market. This is showing that investors still are gravitating towards those more growth, high beta, more offensive parts of the market, which is not something you typically see when you have a very panicked investor, when people are concerned about the economy, or when you think people are concerned about the uptrends or downtrends within the market. So overall, we're seeing a good level of participation from an industry perspective. We're continuing to see a good relative performance in more risk-on offensive type sectors. And this is a good sign as we move into a little bit rockier of a period seasonality-wise. But right now, it looks like the market is on pretty good footing for in the long, intermediate to longer term look. We'll see if that continues, and we hope it does. If it doesn't, and we see those begin to shift towards more of a bearish slant, then of course we'll adjust our view. But right now, we're encouraged by what we're seeing from the market right now.
Excellent. That is excellent. And this the good news is, right, the kind of the choppy period is traditionally a short period of the calendar year. It feels like a long time. So hopefully that gives us something to look forward to as we kind of play this period and look to the good back half of the year. So once again, thank you all for giving us your time. As always, we'll give you a reminder, give us a call, 800-928-4001. And again, by any means, if you have any questions or challenges as we transition and pivot to Schwab, give us a call so we can work through any of those challenges that you have. So thank you and have a great weekend.